Welcome. I'm Roger Montgomery from Montgomery Investment Management. Since the inception of the Polen Capital Global Growth Fund in 2014, the team at Polen have delivered impressive outperformance. But from January this year, war in Ukraine, lockdowns in China, and more recently, concerns about stagflation and even recession have made investing in high-quality, growing companies a little painful. Of course, as history demonstrates, this too will pass. Joining me to discuss the fund's performance, current market conditions, and perhaps an individual opportunity is Damon Ficklin from the Polen Capital Global Growth Fund. Thanks for joining me, Damon.
Thanks for having me, Roger.
I mentioned the global sell-off has been tough to navigate, and it's been particularly challenging for investors who focus on quality and growth. Can you explain why you believe high-quality growth companies, which in the long run we know are the best way to accumulate wealth, have performed poorly recently?
Yeah, I'd say as you pointed out, there are many things going on in the world, but if I had to kind of isolate it down, I'd say that the dramatic change in expectations around interest rates has been kind of an important feature of why high quality, high growth companies have been most impacted. We've certainly gone through periods where interest rate expectations have gone up and down, right? And we haven't experienced this kind of negative impact in quality growth. But I think there's a expectation of persistence in this case because of higher inflation, because of all the things going on in the world. It's not just kind of a near-term adjustment to rates, but a long-term adjustment in expectations. And if you think about quality growth companies, a lot of their value comes in all those future free cash flows, which are growing higher and higher every year. So mechanically, you discount them back. There's a lot of value in those future years. So if interest rate expectations change a lot, which they have recently, you can see that higher end of the curve, more affected than the middle of or the slower growth elements of the market.
Now, you've been doing this a long time, as have I. What have been some of the lessons that you've learned through this period, if any?
Yeah, I'd say, look, you kind of keep relearning lessons in the market,
yeah,
right?
Indeed.
And that's that things can change fast. If you go back just a couple of years, right before the pandemic started, we didn't have any of this within our expectation set, right? And then I think probably 6 months into the pandemic, after what looked like terrible, economic data, we ended up in an environment that was okay, challenging in many dimensions, but okay, right? And now fast forward again, the effects of inflation, all new sorts of things pop up. So I think the thing we have to keep relearning is the market is dynamic. And I think even the best businesses in equities can see a 20, 30, 40% drawdown at some point in the cycle. We've seen that happen across our portfolio with some companies that have had no real change in business results or future expectations. So the market and investing is a humbling thing, which is why we really try to stay focused on the best businesses in the world, take a long-term orientation, not try to make these short predictions because they're really just impossible to predict the short term.
Yeah, definitely that shift in sentiment can occur very quickly. During extreme market volatility, such as we're experiencing at the moment, I know personally, and you probably experience the same thing in the US, investors are often looking for reassurance about the safety of their capital. We've certainly received questions about that, and that's normal. Perhaps you could shine a light on the investment philosophy and the portfolio construction process, as well as the stock selection, and perhaps tease out some of the reasons why, through those things, investors can be optimistic rather than pessimistic.
Yeah, absolutely. I guess from a philosophical point of view, we very much believe in concentrating in the best businesses because we think the best businesses end up being the most durable, deliver the most growth over time, and are resilient. And we do that with a very long-term oriented lens. As I said, we're not trying to predict the next 3 months, 12 months. We're thinking in the next 5+ years. And we think that's infinitely more doable. It's not easy, but with the best businesses, I think you can get to more predictable outcomes in the out years than businesses that are not differentiated, that are not special in any way, that are very dependent on what's going on around them. So a lot of our process is whittling the world down to the handful of companies that we feel most confident in, based upon their position, based upon true economic differentiation, based upon real competitive advantages, based on proven durability and an ongoing growth opportunity. And so there's a lot to be optimistic about. In fact, when we talk about interest rates or inflation or kind of potentially an economic slowdown, I think the kind of businesses we own will actually do very well or relatively well, versus the long tail of all businesses through that type of environment. So the market is shot first and it'll ask questions later. So the story is definitely not over. And I think as we start to see who does well through a tough environment, the businesses that we own, the quality of business that we own is going to prove out to be much more resilient than most other businesses. So unfortunately, valuations have come down quite a bit year to date. The fortunate and optimistic part of that is they're very reasonably valued from our point of view on a look forward basis, and we feel quite confident in the long-term future. So we think we're in a very strong position, and despite the challenging market, we're optimistic about the future.
Yeah, Damon, I can concur. My experience has been that eventually indiscriminate selling gives way to discernment, and the quality of the businesses means that they're growing in value and intrinsic value, and eventually the price catches up to that. It can't be ignored forever. So, yeah, absolutely concur with you. A final question for you. We know the current storm will pass, as have all previous storms. So is there a company you'd like to call out as having great prospects?
Yeah. I mean, there's several. I mean, we could go down the whole portfolio. We feel great about many of them, but I'll just highlight one that I think's a pretty straightforward case, and it kind of encapsulates a lot of the things we're talking about, and that's Adobe. Adobe is the leader in digital media creation and digital marketing capabilities, and has a small kind of digital signature and business as well. But just focusing on digital media, digital marketing, it's I don't want to use the M word, but it's nearly a monopoly in digital media creation in terms of just usage of their products. And then far and away a leader in digital marketing. And so their position has only become stronger. If you look at it today, Adobe's trading for about 25 times forward earnings. That's cheaper than it was for the 5 years leading up to the pandemic. So it's already, adjusted down to pre-pandemic. The market's almost saying that it's a less well-positioned, less valuable business today from just kind of a PE perspective than it was before all this happened. We think the truth couldn't be further away, because if you didn't have a digital marketing capability pre-pandemic, you need one now. The whole world is rushing to modernize their technology infrastructure and only pushing closer to the consumer, pushing closer to a personalized experience and doing that in real time. And there's so much digital media being created. It's all happening, or most of it's happening, on Adobe's tools. So the business is in a great position. There's been very little change in its growth trajectory through the environment and coming out of it. There's certainly the potential for a little bit of a slowdown as we lap some of the really strong COVID years. But if you think in longer term periods, we think the future is very, very bright, and the company is very well valued for its position.
Fantastic, Damon. That's all the questions I've got for you, and we've run out of time. Thanks for joining us, Damon. It looks like the weather's terrific over there in Florida. It's still pitch black here in Sydney, but I look forward to talking to you again soon. Thanks for your time.
Likewise. Thank you, Roger.